Janet Yellen slips, admits why the Fed won't normalize interest rates. Last week, the Fed decided at their September 20th, 21st meeting not to raise interest rates. No surprise there. But after the meeting, Janet Yellen held a press conference and she basically admitted, by not answering the question, that the Fed really is not going to normalize interest rates. And when I say normalize interest rates, I mean not just possibly raise interest rates a quarter point at a meeting once a year or maybe once every 2 years, but this nonsense they've been talking about how they're going to gradually raise interest rates up to a normal rate, which they deem to be about 3% by 2019 and beyond. Now, this is not possible, and we've always said that the Fed could raise interest rates and will raise interest rates when they need to raise interest rates, when either they're losing credibility, and by extension, the dollar is losing credibility and going down. They want to boost the dollar a bit. They have to raise rates. Otherwise, they're more than happy to talk about raising rates and see if that works. But as we'll see, that's losing its effectiveness. So we saw a Comey-esque Fed lay out a rate hike case, but not raise the rates. Now, we've been hearing rate hike, rate hike, rate hike, and another Fed meeting came and went without a rate hike. Like all the prior meetings we've had in the past for the last 2 years, we've had Fed officials, once the market decides to ignore the concept that there might be a rate hike, you get one Fed official after the other pounding the table for imminent rate hikes on the table. Case for rate hikes is strengthening. You even had Janet Yellen at Jackson Hole in August talking about raising rates, and Vice Chairman Stanley Fischer echoed her rate hike call, saying yes, what Janet's talking about is consistent with a rate hike. Economy is strengthening, labor market is robust, consumer spending is solid, words to that effect. Now, I call these Fed chats yak attacks, and they normally come as market participants start to write off the potential of a rate hike and the dollar index starts to slide. Now, these yak attacks, I've argued, and you can click on this link here for a podcast on it, are designed to convince markets that rate hikes are imminent, and that has the impact of boosting the dollar index. And the reason they need that is they want to make sure they have a strong dollar in case they want to pull more shenanigans and print more money and start buying assets, because that would have the impact of pushing the dollar down. Crying wolf. So prior to each Fed meeting for the past 2 years, as we've mentioned, there's been this very vocal chorus of Fed members spewing the rate hike threats. In 2016, there have been 6 FOMC meetings through September and not one rate hike. 2 years ago, they told us by the end of 2016, the projection was they would have raised rates 6 times. Interest rates should be about 2% by the end of this year. Didn't happen. Beginning of 2016, the Fed said, oh, we'll probably raise rates 4 times this year, after they had raised them once in 2015. Well, that hasn't happened. So far, we've had no rate hikes in 2016. So the idea that there's going to be 4 in 2016 is now solidly off the table. Comey-esque. Okay. So after the September meeting, if you look at the FOMC press release, which I've provided a link to in this podcast, and I'll try to provide one in the blog post, and I'll try to provide one at the bottom of the blog, and I will try to provide one at the bottom of the YouTube video as well, if I remember. But there's definitely one down at the bottom of the blog post. The press release talks about the state of the economy and presents a very compelling case for a rate hike. But the FOMC, Federal Open Market Committee, concluded not to raise rates. Very similar, eerily similar to FBI Director James Comey's investigation into Hillary Clinton's classified information, where he concluded no reasonable prosecutor would file charges under these circumstances, when most reasonable prosecutors or even reasonable people heard him lay out a very compelling case against Miss Clinton's handling or mishandling of classified information. So perhaps it's no reasonable Fed would raise rates under circumstances of this solid and strengthening economy and labor market? Guess not. The Fed decided perhaps it would be better to wait and get further confirmation about the strength of the economy. We've heard this before. Wait, 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 patience, patience, patience. But at the same time, they're telling us how wonderful the economy is. It's even so wonderful we'll risk overheating. And so they give the excuse we don't have enough inflation. We don't have the CPI isn't up high enough. Waiting for Godot or the Great Pumpkin, depending on either your literary or popular culture preferences. So each Fed yak attack about rate hikes that ends with another interest rate hikeless FOMC meeting strains the Fed's credibility. And it seems like they're always telling us to wait, 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 and it never comes. Now, when the Fed started these yak attacks, it was very effective. Markets used to respond violently. Oh my goodness, here comes a rate hike. Not only is a rate hike coming, they're going to gradually raise rates once they do the first one. And the equity markets would drop and gold and silver would fall and the dollar would rise. Now, that's fine if the Fed wants to conduct these open mouth operations under their First Amendment, but free markets are also, or I wouldn't say they're free markets, but markets are free to ignore these constant rate hike calls when they never result in any rate hike. We've got a picture here of a crowded theater and someone's yelling rate hike and people just sit there. But here's where, if you're paying attention, which the reporters are not when they ask these questions, in the press conference that followed, if you really want to know whether the Fed is serious about raising rates, you have to look at their justification for raising rates, and it doesn't hold water. So after the FOMC statement was released, Janet Yellen held a press conference, and you had all the corporate establishment media there. They don't ask follow-up questions. The last person who tried to ask a serious question, Pedro da Costa, I think he was with Reuters at the time, he got booted from the meeting. I don't even think he doesn't even work for Reuters anymore. But in any event, you had CNBC, Reuters, AP, Wall Street Journal, Bloomberg, Financial Times, New York Times, Washington Post, Politico, and CNN all asking questions. Note who's on that list and who gets to ask questions. Now, there wasn't much substance to the questions or the answers. You can't expect much. One reporter even asked Ms. Yellen if it made sense for the Fed to take over job training. Because remember, the Fed is in charge of a dual mandate of full employment and price stability. So this reporter was thinking, wouldn't it be wonderful if the Fed can get more involved in full employment, which they have nothing to do with anyway. But you know, they can't handle interest rates. Why would anyone want them to be in charge of job training? If you're interested in hearing our answer, you can go. I have a link. You can listen to the press conference. Only about 1,000 people have viewed it. It's on the Federal Reserve's website. As you can see, it's not a very compelling press conference, but there was something very interesting there. I'm going to get to that. It wasn't until the Bloomberg television reporter asked a question that it became obvious there's holes in the Fed's gradual rate hike story. Now, the Fed has been promising not only is it going to raise rates, remember, it's going to gradually normalize them through these process of rate hikes, and it's all going to be based on the incoming data because monetary policy is not on a set course. Okay. And we've argued that the Fed can't normalize rates, but they can raise them, but they're not going to normalize them, especially when the rest of the world is either at zero or negative rates. Because if the Fed were to raise rates to 1%, 2%, 3%, and all the other central banks are zero, the dollar index would explode. And that would be so deflationary. The Fed doesn't want that because if the dollar is very expensive, that would make any event. The Fed just needs to pay a nominal amount of interest to remain the world's reserve currency and to be able to continue to sell treasury bonds. If they have a too strong dollar, then you have a deflationary environment. If it's too weak, then if there's issues around the stability or the value of the dollar, you've got bigger problems, and you have problems selling treasury bonds. So the last thing they want to do is normalize rates. And also if they normalize rates, meaning they put them up that higher, it harms the U.S. government's ability to borrow money because their interest payments become that much higher. But here's the question that the Bloomberg television reporter asked very astutely. And I'll paraphrase, and you can listen to the exact question. But this is what he said. He said, look, Ms. Yellen, you have these GDP projections from the Fed ranging from 1.8 to 2% over the next 3 years. But yet you have inflation rising from 1.3% all the way up to 2%. And then you have the Fed fund rate moving from 0.06% this year, which means probably one more quarter point hike they're projecting this year, and then moving all the way up to 2.6 in 2019 and over 3% thereafter, meaning that the Fed is still pushing the narrative that they're going to normalize rates, meaning they'll do one or two this year, one or two more this year. They'll do another 3 next year, another 3 the year after. And the Bloomberg reporter was asking, well, given the low growth projections, why do you have these inflation projections going higher? Because he knows the way the Fed thinks is that you get inflation when you get growth, and yet the Fed is saying there is no growth based on their own projections. So why would you project inflation? And therefore, if you're still going to have this low inflation and low growth, why would you be ratcheting rates up all the way up to 2.63%? And Ms. Yellen's answer was, yeah, the growth projections are low, and we had revised down our Fed funds rate projections, and low growth is a concern for policymakers. What? She didn't say anything. She never answered the question that it is incongruous to say that you should boost the Fed funds rate higher than the inflation rate, which doesn't make any sense. And why would the inflation rate be going so high when they've projected low growth? Well, the answer is because the interest rate projections that they have going from basically a quarter point to 3% in a few years are as false as the ones they made 2 years ago when they projected a 2% interest rate by the end of this year. Thanks again for listening, and please remember to subscribe to Smaulgld by putting your email address in here, and also please subscribe to this channel. Thank you.